Hey everybody, welcome to this weekend's episode of the Weekly Wrap. This is episode 18. I actually have kind of a different type of episode this weekend than I normally do. We're not going to be going through any kind of slides or what we usually do. I'm actually just kind of going to make this more podcast friendly, a little less YouTube friendly for this one. I have the S&P 500 chart up right now, and we'll go through it, and we'll talk about some other charts too. But I kind of just want to talk through some things that I don't really get a chance to talk about during the week because I'm kind of just recapping what happened during the day, and you don't really get to dive into it that much. So I kind of just want to dive into that today, and I want to start with what happened this week with the CPI data and basically the rally that followed. There's a lot of speculation in the market right now. I think it's important to talk about. So the reason, if you didn't know, the reason that the markets rallied so hard this week was because the CPI inflation number came in, and it was expected to be at 7.9% year over year, and it came in at 7.7% year over year. So it was slightly lower than expected. And this boosted a lot of confidence amongst investors because now we as investors, not we as myself, but I'll just say investors, I guess, are expecting that inflation has peaked now. And typically when inflation has peaked, it continues to come down pretty sharply. And people are hoping that we're going to get back to the Fed's 2% target fairly quickly, and that the Fed's going to be able to pivot soon. They're not going to have to keep raising rates like they are right now. And the market basically pumped Thursday and Friday. And while it is good that the CPI number was less than expected and it's decreasing and maybe inflation has peaked, the reality of the situation that we're in right now is that inflation year over year is still 7.7%. And that's horrible. The target is 2% year over year. That's the Fed's target for every CPI number that comes out. They want it to be 2% year over year. And we are far from that. And I think even though that it's starting to come down, the Fed's not going to be able to say, hey, we're going to pivot our policy now. This is just one data point. The Fed has made a point throughout this whole market that they're not just looking at a singular data point and to base any of their policy off of. They need to see a pattern. They need to see a trend. And as of right now, there is no trend that says that inflation is coming down. While the case might be that's going to happen, there is no trend right now. I think that this is a Fed that definitely would rather err on the side of hiking too much and breaking something that way than having runaway inflation. So I think while it is good that the CPI number came in the way it did, it doesn't necessarily mean that the Fed's going to pivot. And I think investors were starting to price in this week that that's it. They're going to pause rate hikes. They're going to slow down. Maybe we'll only get like a 25 basis point hike in December, and then they'll pause. And then that's kind of what people are looking at. And I don't know about that. I think that the reality is that we still have 7.7% inflation, and even if the Fed does a good job of bringing it down, it's still going to take a long time to get back to the 2% target. I mean, we're barely down 1% from the peak, and it's taken months. So how long is it going to take to get it down another 5.7%? That's all I'm saying is the reality of the situation is not as good as what people think it is. Additionally, China could still invade Taiwan, which would disrupt our supply chain even more than it's already disrupted, and that would hurt the markets as well. And we have a housing market that's crashing, and that's not good for consumer sentiment or just discretionary spending in general. And the consumer sentiment is down. It was lower than expected. That also came out this week. So people are struggling. The people in the world are struggling. And while the stock market does not reflect the economy, the stock market is not the economy. There's a lot of things going on right now that I think people are kind of just ignoring, and we're getting over speculative. And every time this market gets speculative, it seems to come back down. So if you look at the chart here, and if you're listening to the podcast, I'll just kind of talk you through it. So we're kind of bowling towards this 200-day moving average, and we've talked about over the course of the last few months the importance of the 200-day moving average. And we know that markets that spend a significant amount of time below the 200-day moving average, and this market has spent a significant amount of time below the 200-day moving average, that once it breaks above, that's an extremely bullish signal. And what it tells us throughout history is historically the bottom is in if we break through this 200-day moving average. That would mean that this level right here at around the 34.90 was the bottom. And that's what that would tell us if we broke above the 200-day moving average. Odds are, it's not 100%, but it would be a pretty bullish signal. And then additionally, we have this trend line on the S&P 500 as well. That's held up pretty strongly for us throughout this bear market. So where are these levels at if you're listening to the podcast? Well, the 200-day moving average right now is at 4,081.05 cents. And right now, the S&P is at 39.92. So we're not too far away from the 200-day moving average, only a couple percentage points. And I could see us maybe bowling throughout the beginning of the week up to this level and then selling off. And where's the trend line at? Well, that's a little more unclear, but right now it's at about 4,100. So it's just slightly above the 200-day moving average, and that would also act as resistance in this market, as it's held up since the beginning of the sell-off. It actually goes from the peak of this market. So there's a lot of speculation going on right now, and when that's happened in this market, we've hit levels and simultaneously maybe gotten some data points that have made this come back down. So is the Fed going to come out next week maybe and just kind of ease the speculation a little bit? Maybe, I don't know. The bottom could be in this market. It might not be. This was only one data point. So that's basically what I'm trying to say is don't get caught up in the FOMO, because that's where bad investing decisions come in. And another thing I wanted to talk about that kind of leads me to my next point is I've kind of been preaching this dollar cost averaging during this market and not trying to pick the bottom. And the reason for that is there's so many variables going into this bear market right now. So you can't really pick one thing and then know that's when you're going to put in your lump sum, because there's so many different things kind of moving this market around. I think it's too hard, and it's not profitable to try and pick a bottom. It's more profitable to just dollar cost average your way in. And that's what I've done. It's been very successful for me throughout this bear market, is just dollar cost averaging every month, every couple weeks. For me, each account has a different frequency that I invest, and I just invest every time I have a schedule, and every time it's time to invest in one of my accounts, I invest and I allocate based on the allocation that I've set for myself. And that way you're not succumbing to the emotions of this market. You're not getting caught up in the fear. You're not getting caught up in the FOMO. If the market's going down, you're getting more shares for the amount of money that you're putting in. And if the market's going up, then you're getting less shares, but your portfolio value is rising. So, I mean, really, there's no way you can go wrong with dollar cost averaging. That's what I've been doing. It's been going great. I've been averaging down in positions that are down for me, and I've been adding to winners as well at the same time. So I think that works as long as you've vetted your portfolio and you're not spread out into assets that aren't good. I know for me, with all the crypto stuff that's going on, and we'll talk about that in a second, all the crypto stuff that's going on, I've kind of been wary of the Ethereum that I own, even though my crypto portfolio right now is about 70% Bitcoin, 30% Ethereum, and I'm only adding to the Bitcoin position as of right now. And that'll change actually, because I have a lump sum that I want to put in. So it'll go more towards 85 to 90% Bitcoin and about 15 to 10% Ethereum. And the reason that I like, actually, let's go to Bitcoin right now. Let me pull up the chart. The reason I like Bitcoin so much is the security and the privacy. So this isn't something that's owned by an entity or by one person like Ethereum is, or created and controlled. This is completely decentralized as long as you take self-custody of it, which is proving to be more relevant every day this week with everything that's going on at FTX and a bunch of crypto exchanges around the world becoming insolvent. It's crucial that you take self-custody of your Bitcoin, or else it's not really yours. At FTX, they had like 1.1 Bitcoin in their reserves versus I don't even know how many Bitcoin that their customers had claimed through the platform. And that's not the way it's meant to be used. If these crypto exchanges go insolvent or bankrupt and you have assets on the platform, they don't have to pay you your assets back if they go bankrupt. You're kind of just at the mercy of the exchange, and you don't have the freedom to transfer it and move around your assets as you please. You're kind of at the mercy of the exchange, and you have to pay all the fees that come with that. So I recommend getting something like a ledger, or there's a lot of other products that are similar to that, where you just take self-custody of your Bitcoin. It's in cold storage. You own the keys. And so you are your own bank essentially at that point. So I have all my Bitcoin in cold storage. I have my Ethereum in cold storage as well. I don't stake any of it. But yeah, so that what that means is that I'm not at the mercy of an exchange. I'm basically my own bank. I can sell it when I please. I can buy more when I please. I can transfer it to whoever I want without having to go through an exchange. It's just my wallet that I own. I own the keys for it. And that's the way this is meant to be used. That's what it was built for. Anytime you have an asset that's becoming more valuable, you'll have entities that try and control it and profit from it. That's basically what these exchanges are doing, and you're seeing the danger of that. They're over leveraged. They're buying these shit coins, which I think 99% of crypto is absolutely worthless, and you're probably going to see more of that in the coming months. But for me, my convictions in Bitcoin, I used to have a conviction in Ethereum, and until I really studied it and understood it more and started seeing what's going on in the crypto world, it's okay to admit that you're not as well informed in an area as you are somewhere else. Like for me, crypto, I'm not as strong in crypto as I am in the stock market, but I'm able to recognize that Bitcoin has this true intrinsic value, and I can't find that really anywhere else. I can find a use case for Ethereum, but there's dangers in it because it's able to be controlled by an entity, and that's really the reason that I wanted to buy Bitcoin. Is it's not controlled by one entity. It's not centralized. It's completely decentralized and owned by the people. And yeah, so I still own a little bit of Ethereum. It's not anything that can sway my overall portfolio at all. Even if it went to zero, it won't even affect my portfolio really. But I'm going to hold on to it because I just don't see any reason in selling it. It wouldn't really do me any good converting it to Bitcoin because it's not really that much. And I'm going to continue adding to my Bitcoin and putting it all into cold storage. That's really my plan as far as crypto goes. I don't see anything worth putting my money into that's not Bitcoin. I don't. So if the situation comes along that I do, I'll let you know that I've changed my mind. But for now, my conviction resides in Bitcoin alone. And that's what I'll continue to put my money in as the price goes down. Again, I'm looking for anything between like 7 to 8,000 and 12,000 on Bitcoin to put my lump sum in. I would be happy with a price anywhere in that range to hold for honestly, for me, I'm holding Bitcoin for 50 plus years. So if I can get it at that price, I'd be ecstatic because that's a wonderful price to hold for the long term. So that's what I'm looking at. Again, everything that's going on in these crypto exchanges, it's going to shake the confidence in crypto a lot. You're going to start hearing people say that it's a scam, that it's not reliable, that it's fake. And for the most part, when it comes to a lot of these exchanges and these cryptocurrencies, that is true. I don't think there's value in 99% of the space. But the technology and the ability of Bitcoin, I wish I was able to speak on it more. If you are more interested in learning about Bitcoin, there's a great podcast that I listen to. It's called the We Study Billionaires podcast, and every Wednesday they come out with a Bitcoin episode. And that's really a great place to learn. That's where I've gathered a lot of the information that I know about Bitcoin. And it's just it's good to learn about this space because it is a rising asset class. I do believe that people should have exposure to Bitcoin in their portfolios. But when it comes to the other cryptos and the exchanges, I think people just don't really know how to invest or store it, really. That's the problem. And then people get caught up in a situation like FTX. It's actually funny. So BlockFi is another one that's insolvent. They were holding about 90% of their assets through FTX, and I actually used to hold my Bitcoin and Ethereum on BlockFi until I put it into cold storage when I started learning more about it. So I was really, really happy that I made that change before they paused withdrawals and announced that they basically were insolvent. But it just goes to show why it's so important. Again, FTX was like the second biggest crypto exchange in the world. And it was capable. This was still able to happen. So that's really what I wanted to say about that. But in other news, there is still opportunity in the stock market. So let's shift back to stocks. So even though there's a lot of FOMO in this market, there still is immense opportunity. Let's take ARK Invest, for example. Even with the recent moves this week, it was up like 20% this week. Look at how far off it is from the levels that it was at before. And this is really reflective of what these companies were able to do in a low interest rate environment. So I don't necessarily think that, if the bear market's over, ARK Invest is heading back to 160. I think it could take a long time to get back to that level, but we are trading at COVID pandemic levels in ARK Invest. And I do think that that's a little bit irrational. I think that these are some solid companies that she has in her fund, some companies that could disrupt the technology industry and that could shape our future and cause deflation. And that's really what she preaches with her firm. And so I think there's a lot of opportunity in spaces like this, as well as some other companies. For example, if we just look at let's take a look at Alphabet. So Alphabet, again, great company, huge moat. They grow at a faster pace than the market, and they're down a ton from the highs. So there's opportunity in this market still. That I didn't want to scare anybody away from that. There's definitely still immense opportunity. But that's basically what I wanted to talk about today. I kind of just wanted to slow down and recap what happened this week, kind of talk about it a little bit more. I mean, even if you look at this chart stripped away of all the levels that I have on the S&P 500, if you look at where we're headed, without a policy change, I don't know how we break above the 200-day moving average. I mean, maybe we do, but I think it's more likely that we end up bouncing off and whether we have a double bottom around this level, the 3,500 right here on this line, whether we have a double bottom here or we have another leg down to like the 3,250, what I've been saying. I think that's more likely than just bowling back above this trend line, going back to all-time highs, because interest rates are still going to go higher than they are from here, and inflation is still 7.7%. So to me, the fundamentals say to be a little cautious, even though we got a good data point. It's not enough yet. It's not enough. It's a good sign. Maybe the bottom is in. Maybe we double bottom, but I don't think we're surging to all-time highs just yet. Still a lot of factors playing into this market. So I'm going to leave it here. I'm not going to ramble on. I think that I just got my point across, and that's enough. So I hope that this information was helpful, and I don't know. I hope that this format is good for the weekends. I kind of like just being able to talk and not have any sort of like structure on the weekends. So maybe I'll start doing this episode as a more podcast-friendly episode, a little bit less YouTube-friendly. I do get a majority of my viewership from the podcast, so maybe I'll start tailing a little bit more to that. But still have the charts up on the YouTube, so you're still getting some good info on the YouTube. Not just saying that I'm blowing off the YouTube here. But if you like this content, please subscribe on YouTube and follow us wherever you listen to podcasts. I hope you're able to take some some good bits from this, and I'll see you next week. Again, we'll have an episode out every day that the market's open, and then another episode like this over the weekend. I appreciate you listening or watching this episode, and until next time, thank you for listening.